Section 4:1 to 4.3 Cost averaging. 4.1 Tax efficiency. When considering tax-efficient investment vehicles and account types, there are several options to explore. Here are some common options to consider. Tax-advantaged retirement accounts. Tax-advantaged retirement accounts, such as traditional IRAs, Roth IRAs, and 401k plans, offer potential tax benefits. Contributions to traditional IRAs and 401k plans are typically made with pre-tax dollars, reducing your current taxable income. Roth IRAs, on the other hand, allow for after-tax contributions but offer tax-free growth and tax-free qualified withdrawals in retirement. These accounts can provide a tax-efficient way to invest for retirement. Index funds and ETFs. Index funds and exchange-traded funds, ETFs, are investment vehicles that aim to track specific market indices. These funds tend to have lower turnover and lower capital gains distributions compared to actively managed funds. Lower turnover means fewer taxable events, potentially reducing your tax liability. Additionally, ETFs have a unique creation and redemption process that can help minimize capital gains distributions. Tax-managed funds. Tax-managed funds are mutual funds that employ strategies to minimize taxable events and maximize after-tax returns. They aim to reduce capital gains distributions by selectively trading securities and using other tax-efficient techniques. These funds are specifically designed to be tax-efficient and can be a suitable choice for taxable investment accounts. Municipal bonds. Municipal bonds are debt securities issued by state and local governments. The interest income generated by municipal bonds is often exempt from federal taxes and, in some cases, state and local taxes if you reside in the issuing state. Investing in municipal bonds can provide tax advantages, especially for investors in higher tax brackets. Health savings accounts, HSAs. HSAs are tax-advantaged accounts available to individuals with high-deductible health insurance plans. Contributions to HSAs are tax-deductible, and withdrawals used for qualified medical expenses are tax-free. HSAs offer a triple tax advantage: contributions are tax-deductible, growth is tax-free, and qualified withdrawals are tax-free. Real estate investment trusts, REITs. REITs are investment vehicles that own and manage income-generating properties, such as office buildings, shopping centers, or apartment complexes. REITs typically distribute a significant portion of their income as dividends, and some of these dividends may qualify for favorable tax treatment. A portion of REIT dividends may be classified as qualified dividends and taxed at lower rates. Tax loss harvesting. Tax loss harvesting involves selling investments that have incurred losses to offset capital gains or to deduct losses against ordinary income. By strategically selling investments at a loss, you can potentially reduce your overall tax liability. Tax loss harvesting can be implemented within taxable investment accounts and can help optimize your tax efficiency. It's essential to consult with a financial advisor or tax professional who can provide guidance specific to your individual circumstances and the tax laws of your jurisdiction. They can help you evaluate the most suitable investment vehicles and account types based on your financial goals, risk tolerance, and tax considerations. Tax loss harvesting is a strategy that involves selling investments that have declined in value to offset capital gains and potentially reduce your overall tax liability. Here are some key points to consider when utilizing tax loss harvesting strategies. Identify investments with losses. Review your investment portfolio and identify investments that have declined in value since you purchased them. These investments are potential candidates for tax loss harvesting. Consider capital gains. Assess your capital gains for the year. If you have realized capital gains from the sale of investments that will be subject to taxes, you can utilize tax loss harvesting to offset those gains and potentially reduce your tax liability. Be mindful of wash sale rules. The IRS has wash sale rules that prevent you from claiming a tax loss if you purchase a substantially identical investment within 30 days before or after the sale. To comply with these rules, you may need to wait for at least 30 days before repurchasing the same or substantially identical investment. Offset capital gains and deduct losses. By selling investments with losses, you can use those losses to offset any capital gains you have realized in the same tax year. If your losses exceed your gains, you can use the excess losses to offset up to $3,000 of other income. Any remaining losses can be carried forward to future years. Consider reinvesting the proceeds. after selling investments with losses, you may choose to reinvest the proceeds in similar but not substantially identical investments. This way, you can maintain exposure to the market while still benefiting from the tax loss harvesting strategy. Assess long-term versus short-term capital gains. Keep in mind that long-term capital losses can only offset long-term capital gains, and short-term capital losses can only offset short-term capital gains. If you have a mix of long-term and short-term gains, you can apply losses accordingly to maximize the tax benefits. Consider the net investment income tax. High-income earners may be subject to the net investment income tax (NIIT) on certain types of investment income. Utilizing tax loss harvesting strategies can help reduce your net investment income and potentially lower your NIIT liability. Consult with a tax professional. Tax rules and regulations can be complex, and the effectiveness of tax loss harvesting strategies may vary depending on your individual circumstances. It's advisable to consult with a tax professional who can provide guidance specific to your situation and help you navigate the tax implications of tax loss harvesting. Remember that tax loss harvesting should be approached as part of an overall tax planning strategy and long-term investment plan. It is essential to consider the potential impact on your investment strategy, transaction costs, and your long-term investment goals when implementing tax loss harvesting strategies. Utilizing tax loss harvesting strategies to offset gains can be an effective way to minimize your tax liability. Here's how you can go about it. Identify investments with losses. Review your investment portfolio and identify investments that have declined in value since you purchased them. These are the investments with potential losses that can be used for tax loss harvesting. Determine capital gains. Assess your capital gains for the year. Calculate the gains you have realized from the sale of investments that will be subject to taxes. These gains can be offset by the losses generated through tax loss harvesting. Mind wash sale rules. Be mindful of the IRS wash sale rules, which prevent you from claiming a tax loss if you purchase a substantially identical investment within 30 days before or after the sale. To comply with these rules, you may need to wait for at least 30 days before repurchasing the same or substantially identical investment. Sell investments with losses. Once you have identified the investments with losses and considered the wash sale rules, sell those investments to generate the losses that can be used for tax loss harvesting. The losses can offset an equal amount of capital gains. Offset capital gains. Use the losses generated through tax loss harvesting to offset your capital gains. This can reduce or eliminate the capital gains tax you would have to pay on those gains. Deduct losses against ordinary income. If your capital losses exceed your capital gains, you can use the excess losses to offset up to $3,000 of ordinary income, $1,500 if married filing separately. Any remaining losses can be carried forward to future years to offset future capital gains and potentially provide further tax benefits. Consider reinvesting. After selling investments with losses, you may consider reinvesting the proceeds in similar but not substantially identical investments to maintain exposure to the market while still benefiting from the tax loss harvesting strategy. Monitor future tax implications. Tax loss harvesting can have implications for future tax years. Consider the potential impact on your tax situation and investment strategy in subsequent years when planning your tax loss harvesting strategy. Consult with a tax professional. Tax rules and regulations can be complex, and the effectiveness of tax loss harvesting strategies may vary depending on your individual circumstances. It's advisable to consult with a tax professional who can provide guidance specific to your situation and help you navigate the tax implications of tax loss harvesting. Remember to incorporate tax loss harvesting as part of your overall tax planning strategy and consult with a tax professional to ensure that you understand the rules and regulations applicable to your situation. By strategically utilizing tax loss harvesting, you can potentially minimize your tax liability and optimize your after-tax investment returns. 4.2 dollar cost averaging in different market environments. Adapting the dollar cost averaging (DCA) strategy in bull and bear markets involves making adjustments based on the prevailing market conditions. Here's how you can adapt the DCA strategy in different market scenarios. Bull markets. In a bull market, where prices are generally rising, you can continue with your regular DCA contributions as planned. However, you may consider monitoring the market closely to assess whether adjustments are needed. If the market becomes overheated or valuations appear stretched, you might consider reducing the frequency or amount of your contributions to exercise caution and avoid potential market peaks. Bear markets. In a bear market, where prices are generally falling, DCA can be particularly advantageous. It allows you to take advantage of lower prices and potentially accumulate more shares at discounted prices over time. During a bear market, you may consider increasing the frequency or amount of your contributions to capitalize on the downward trend. By consistently investing during the downturn, you can benefit from the eventual market recovery. Volatile markets. During periods of high market volatility, where prices experience significant fluctuations, DCA can help smooth out the impact of short-term market movements. Stick to your regular contribution schedule and avoid making knee-jerk reactions based on short-term market swings. By investing consistently over time, you can mitigate the impact of market volatility and potentially achieve better long-term results. Rebalancing. Regardless of the market conditions, it's important to periodically review and rebalance your portfolio. Rebalancing involves adjusting your asset allocation back to your target weights. During bull markets, certain asset classes may outperform others, causing your portfolio to become overweight in those assets. In bear markets, some assets may decline more significantly, causing your portfolio to become underweight. By rebalancing, you ensure that your portfolio remains aligned with your long-term goals and risk tolerance, flexibility, and adaptability. While DCA provides a disciplined approach to investing, it's important to remain flexible and adaptable in response to changing market conditions. Stay informed about economic trends, market indicators, and any significant developments that may impact your investment strategy. This allows you to make informed decisions and adjust your DCA approach when necessary. Remember that timing the market consistently and accurately is challenging. DCA is designed to minimize the impact of market fluctuations by spreading investments over time. It's a long-term strategy that focuses on consistent contributions rather than trying to time the market. By staying disciplined, patient, and focused on your long-term goals, you can navigate both bull and bear markets effectively with the DCA strategy. Evaluating the impact of market trends and economic conditions on the investment approach is an important aspect of investment decision-making. Here are key points to consider when assessing the influence of market trends and economic conditions. Market trends. Monitor market trends to understand the direction in which asset prices are moving. This includes analyzing factors such as the overall market performance, sector performance, and investor sentiment. Recognize that market trends can be short-term or long-term and can have different impacts on various asset classes. Economic conditions. Stay informed about economic indicators such as GDP growth, inflation, interest rates, employment data, and consumer confidence. These indicators can provide insights into the overall health of the economy and its potential impact on investment returns. Economic conditions can influence sectors differently, and certain investments may be more sensitive to economic changes than others. Fundamental analysis. Conduct fundamental analysis to assess the intrinsic value of investments. Evaluate factors such as a company's financial health, competitive position, industry dynamics, and growth prospects. Economic conditions can impact the fundamentals of companies and industries, which in turn can affect the performance of investments. Asset allocation. Consider adjusting your asset allocation based on market trends and economic conditions. For example, during a period of economic expansion and bullish market trends, you may consider allocating a higher proportion of your portfolio to growth-oriented assets such as stocks. Conversely, during a downturn or bearish market trends, you may shift towards more defensive assets such as bonds or cash. Diversification. Maintain a diversified portfolio to help mitigate the impact of market trends and economic conditions on your overall investment approach. Diversification involves spreading investments across different asset classes, sectors, and geographic regions. This can help reduce the concentration risk and provide potential benefits of risk management and potential returns. Long-term focus. While market trends and economic conditions can influence short-term performance, it's important to maintain a long-term focus. Avoid making knee-jerk reactions based on short-term fluctuations. Evaluate the underlying fundamentals of your investments and consider how they align with your long-term investment goals and risk tolerance. Consult professionals. consider seeking advice from financial advisors or investment professionals who can provide insights and guidance tailored to your individual circumstances. They can help analyze market trends, economic conditions, and their potential impact on your investment approach. It's important to note that predicting market trends and economic conditions with precision is challenging, if not impossible. Market timing is generally not a reliable or consistent strategy. Instead, focus on understanding the broader market and economic landscape and aligning your investment approach with your long-term goals and risk tolerance. Regularly review and adjust your investment strategy as needed to ensure it remains in line with your objectives and the prevailing market and economic conditions. Taking advantage of opportunities presented by market cycles involves recognizing and capitalizing on the patterns and trends that occur in financial markets over time. Here are some key considerations for leveraging market cycles. Understand market cycles. Market cycles typically consist of 4 phases: expansion, peak, contraction, and trough. During the expansion phase, economic activity and asset prices rise. The peak represents the market's highest point before a contraction occurs, leading to a downturn and ultimately reaching a trough. Familiarize yourself with these phases and their typical characteristics to gain insights into potential opportunities. Buy low, sell high. The basic principle of taking advantage of market cycles is to buy assets when they are undervalued and sell them when they are overvalued. During market contractions and troughs, prices tend to be lower, presenting opportunities to buy assets at discounted prices. Conversely, during market expansions and peaks, prices may become inflated, suggesting it could be an appropriate time to consider selling or reducing exposure to certain assets. Long-term investment horizon. Successfully navigating market cycles often requires a long-term investment horizon. Short-term market fluctuations can be unpredictable, but over the long run, markets tend to trend upward. By maintaining a long-term perspective, you can avoid making rash decisions based on short-term market volatility and focus on capturing the potential returns offered by different market cycles. Asset allocation and rebalancing. Adjusting your asset allocation and periodically rebalancing your portfolio can help you take advantage of market cycles. During market expansions, you may choose to allocate a larger portion of your portfolio to growth-oriented assets like stocks. As market conditions change and a contraction or trough approaches, you can rebalance your portfolio by reducing exposure to certain assets and increasing allocations to more defensive options, such as bonds or cash. Research and due diligence. Thorough research and due diligence are crucial for identifying investment opportunities within market cycles. Analyze individual stocks, sectors, or asset classes to assess their potential for growth or decline in relation to the current market phase. Consider fundamental analysis, technical analysis, and staying informed about economic indicators and market trends to make informed investment decisions. Dollar cost averaging. Dollar cost averaging, DCA, can be a useful strategy in taking advantage of market cycles. By investing a fixed amount at regular intervals, regardless of market conditions, you automatically buy more shares when prices are low and fewer shares when prices are high. This approach allows you to average out the impact of market volatility and potentially benefit from the lower prices during market contractions or troughs. Patience and discipline. Patience and discipline are essential when capitalizing on market cycles. Timing the market perfectly is extremely difficult, if not impossible. Instead, focus on adhering to your long-term investment plan, making strategic adjustments based on market conditions, and avoiding knee-jerk reactions driven by short-term market movements. It's important to note that market cycles are not predictable with certainty, and there are no foolproof strategies for consistently timing the market. The goal is to position yourself to benefit from the potential opportunities that arise during different phases of the market cycle. By staying informed, maintaining a long-term perspective, and making well-informed investment decisions, you can increase your chances of capitalizing on market cycles. 4.3 Combining dollar cost averaging with other investment strategies. Integrating dollar cost averaging, DCA, with other investment approaches, such as value investing or asset allocation, can provide a well-rounded and diversified investment strategy. Here are some ways to combine DCA with these approaches. Value investing and DCA. Value investing involves identifying undervalued assets and purchasing them with the expectation that their value will increase over time. DCA can be integrated with value investing by applying the principles of value investing when selecting investments for regular contributions. As you contribute regularly, you can focus on identifying assets that are trading at a discount to their intrinsic value. By consistently investing in undervalued assets over time, you can potentially benefit from their long-term appreciation. Asset allocation and DCA. Asset allocation involves diversifying investments across different asset classes, such as stocks, bonds, and cash, to manage risk and optimize returns. DCA can be integrated with asset allocation by systematically allocating contributions to different asset classes based on your desired allocation percentages. For example, if your target asset allocation is 60% stocks and 40% bonds, you can allocate a fixed portion of your contributions to each asset class. This ensures that your portfolio remains aligned with your long-term investment strategy even as you continue to invest regularly. Systematic rebalancing. Regular contributions through DCA can facilitate systematic rebalancing of your portfolio. Rebalancing involves periodically adjusting your asset allocation back to your desired target weights. When certain asset classes outperform others, your portfolio's allocation can deviate from your intended strategy. By consistently investing and monitoring your portfolio, you can identify opportunities to rebalance by selling assets that have become overweight and buying assets that have become underweight. This helps maintain the desired risk profile and potentially takes advantage of market trends. Combination of strategies. You can also combine DCA, value investing, and asset allocation into a comprehensive investment approach. For example, you can utilize DCA to make regular contributions to a diversified portfolio that aligns with your asset allocation strategy. Within that portfolio, you can apply value investing principles to identify undervalued assets for additional purchases or rebalancing. This combination allows you to benefit from the discipline and consistency of DCA, the potential for long-term value appreciation through value investing, and the risk management benefits of asset allocation. Remember that each investment approach has its own considerations and requires research, analysis, and discipline. It's important to understand the principles and strategies behind each approach and how they complement one another. Consider your risk tolerance, investment goals, and time horizon when integrating different investment approaches. Regularly review and assess the performance of your investments, making adjustments as needed to stay on track with your overall investment strategy. Customizing your investment strategy to align with specific financial goals and risk preferences is essential for achieving long-term success. Here are key steps to customize your investment strategy. Define your financial goals. Start by clearly defining your financial goals. Are you saving for retirement, a down payment on a house, education expenses, or something else? Determine the time horizon for each goal and the desired outcome. This will help you set realistic expectations and establish appropriate investment strategies. Assess your risk tolerance. Evaluate your risk tolerance, which refers to your ability and willingness to endure fluctuations in the value of your investments. Consider factors such as your investment knowledge, time horizon, financial obligations, and emotional capacity for risk. Understanding your risk tolerance will guide you in determining the appropriate asset allocation and investment options. Asset allocation. Based on your financial goals and risk tolerance, determine your asset allocation. Asset allocation refers to the division of your investment portfolio among different asset classes, such as stocks, bonds, cash, and alternative investments. A balanced asset allocation that considers diversification can help manage risk and optimize returns. Investment vehicles. Select the investment vehicles that align with your customized strategy. These may include mutual funds, exchange-traded funds, ETFs, index funds, individual stocks, bonds, real estate investment trusts, REITs, or other options. Consider the advantages, risks, costs, and tax implications associated with each investment vehicle. Regular monitoring and adjustment. Regularly monitor the performance of your investments and periodically review your strategy. Assess whether your investments are on track to meet your financial goals. Adjust your asset allocation or investment selections as needed, considering market conditions, economic factors, and any changes in your financial situation or risk tolerance. Dollar cost averaging, DCA. Consider integrating DCA into your customized strategy. DCA involves investing a fixed amount of money at regular intervals, regardless of market conditions. It helps smooth out the impact of market volatility and can be particularly useful for long-term investment goals. Determine the frequency and amount of your DCA contributions based on your financial capacity and objectives. Risk management strategies. Explore risk management strategies that align with your risk preferences. This may include setting stop-loss orders, diversifying across asset classes and geographies, utilizing hedging instruments, or incorporating alternative investments with lower correlation to traditional markets. Regular review and adjustments. Regularly review and adjust your investment strategy as necessary. Life circumstances, financial goals, and market conditions can change over time. Stay informed about changes in the investment landscape, economic indicators, and regulatory developments that may impact your strategy. Remember that customization is key to aligning your investment strategy with your specific financial goals and risk preferences. Consider seeking professional advice from a financial advisor who can provide personalized guidance based on your unique circumstances. Regularly revisit and update your strategy to ensure it remains relevant and effective in helping you achieve your financial objectives.